You're like always looking at the hedge funds. I guess Mr. Paulson was off 2 years ago. Now he's up. Mr. Icahn is doing what he's doing. Is it just sort of get lucky with Time Warner Cable, and that's really all this has come down to?
Well, no. At this stage of a cycle, you have tons of corporate activity because balance sheets are strong. There's less growth than people would hope for. So management teams are looking for ways to do accretive deals and boost shareholder returns. So part of that is mergers, part of it's acquisitions, part of it's managers getting active to drive constructive change and reward all long-term shareholders.
Within hedge funds, and I think of Sebastian Malaby's More Money Than God and Julian Robertson, a hedge is a trade. Is this what this really about is? I'm going to bet on Time Warner and I'm just going to leverage up? Is that the only real difference?
No, so the difference right now for those types of positions is that guys will be long the company that's going to be acquired.
Time Warner Cable.
Time Warner Cable. Or in the case of, if you look at a Teva or a Mylan right now, people have to decide, is Mylan going to be bought by Teva? And if so, we're going to own Mylan.
Do they take both sides or do they take one side?
These days they tend to take one side because if a deal breaks and you're on both sides, meaning you're short the acquirer and long the company to be acquired, then you get double blasted. If you're long only the one leg, then you have less downside.
Is that a hedge fund?
Yeah, that's a hedge fund strategy right now. Now, again, hedge funds define a lot of different things. Most managers in this space are long biased, and the majority of their hedges are against ETFs or index hedges.
I'm going to editorialize here. I love what you say, Troy. Totally get it. All it is the application of leverage on a traditional long strategy here.
No, it's very target-focused on hard corporate catalysts, where you're either driving the change as an activist, or you're involved in announced deals, or trying to look where consolidation is going to take place, like in the healthcare industry.
I mean, we've been talking about, equities right now, long, short. In your notes, you have a move into another asset, a much less liquid asset, which is wireless spectrum. Yes, I'm ripping up the script so we can talk about wireless spectrum.
Yes.
What is your position? Well, that's not very liquid.
It's incredibly exciting because it's one of the few things we see out there that's extremely rewarding in terms of upside potential. Long story short, these are companies that went bankrupt back in 2010. Underlying hedge fund owns the corporate entity, and the FCC auctions created tremendous value. And so if those things trade anywhere near the value of the auction, there's lots of upside.
Trade, that's the question. You can pick these up, but like I said, there's no secondary market for spectrum at all. How do you dump it when you're done?
There's a secondary market for the securities of the companies, but the key, and this is a great point you raise, it's only worth what someone will pay for it. So you need a strategic acquirer to bid for that, to realize the gain.
Come on, nothing's changed in 40 years. You're just trying to game who's going to get taken out next with the application of leverage, right?
Again,
I'm going to kill you on this. I'm not letting you off the hook.
We prefer strategies that use rational amounts of leverage.
Right. I'll give you rational leverage. Here's the money quote, though. And I go to Copeland and the Wall Street Journal, our people. It's always like, oh, my God, this celebrity guy's making a lot of money or losing a lot of money. Who is losing right now? You never talk about that.
That's a great point. This year, we would say the year started out great for macro managers as they were betting on the continued decline in treasury yield. For the past 3 to 4 weeks, or 6 to 8 weeks, have been very problematic. So most of them have given back some of their gains from last year.
In your experience, can Jim Chanos or people like Mr. Chanos, can they shift from short psychology to long psychology?
Very hard.
I agree.
It's almost impossible. So if you look at going into a bear market, very few people get that right. And 8 of the 10 guys that get the bear market call right never call the turn. So they basically give up their entire bear market gains from being short in the first 3 to 6 months of the following bear market. Very, very hard to change your direction.
Is 2 and 20 still solid, or are we down to 1.5 and 12?
Yeah, so our weighted average fees right now are about 1.3 and 17.
Thank you.
So we're trending in the right direction. The hedge fund industry understands that in a low return environment, they have to offer more competitive fees.
He could sell me a used car.
See, you're too kind, Tom.
You're spinning. Dan Loeb, if you're watching this, let me translate what I just heard. 2 and 20's dead, and the new thing is 1.3, and I make 17% up top.
Thank you for pointing that out to Dan.
I mean, we're talking about everything Troy Gayeski could sell. I just want to point out that both on TV and in radio, you cannot see his cufflinks. The guy is put together. He is ready to sell.
A gift from my wife, by the way.
I also have to point out,
McKee.
The subtext of this last block was, Tom, I want to talk about hedge funds. Brendan, I want to talk about Spectrum. Tom, no, we're going to talk about hedge funds.
We're talking about the way people are making money. The most important thing before Twitter today is Michael McKee of Bloomberg Radio, Bloomberg Television, is wearing drachma cufflinks. Drachma cufflinks.
And he has been waiting for the right day to bring them out. Today is the day when we might need extra drachmas. He's carrying them on his person.
McKee.